Okay. Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:42 p.m. on a cloudy and somewhat balmy evening here on the New Jersey, New York City waterfront, overlooking the Statue of Liberty, Lady Liberty. Tonight, as we always do, is the weekend strategic webinar on October 7th, 2018. The session will be recorded and uploaded to the Clueless Trading YouTube channel for free viewing by anybody who has an internet connection. And also, please feel free to join us, follow us at least, for promotional purposes. We're trying to get the word out there where Clueless Trading is, because we are kind of a secretive organization, for a better choice of words. We are a terrific trading club. We deal with all types of markets. We try to remove the emotions out of every single thing that happens in the markets. Very difficult sometimes. I understand that. I'm a human being after all. But at the same time, for promotional purposes, do follow us on Instagram at Clueless Trading. We have a Facebook, we have a LinkedIn page, and all of those should be followed. But Instagram is what we're trying to promote so we can get the word across. On that note, let us begin our session, and thank you for attending. We have DC Trader, we have Razia185, and we have hopefully a new member who's going to join us and learn the mechanics of how to make real money in financial markets, at least in the U.S. financial market, and that is Yvonne. So on that note, let us begin. So before I go any further, what you're seeing behind you is a live chart, as I always start off with, on the E-minis, which are the S&P 500 index futures. And this is the 50.
Hey, Frank?
Yes, go ahead. Oh, I didn't change the.
Yeah, I don't think you're sharing. You're not sharing yet.
Yep, I'm not sure.
Okay.
There you go. Okay. My apologies. Thank you for somebody correcting me. Okay, so the visuals are on right now. We have my good friend Mike Harrington, Mike here online too on the webinar, and I do apologize that the screens were not sharing earlier. So right now you should be fine, right, DC?
Yep, we can see everything.
Okay, so what we have behind us is a live money flowing back and forth in the Globex markets, thousands of dollars, millions of dollars in some cases, or hundreds of thousands of dollars on the E-mini futures, which are the S&P 500 index futures, and basically these are the puppet masters which control the strings of the puppets, what we call the external market, known as the S&P 500 and all the stocks that we trade. It's really as simple as that. One day I'm going to draw a puppet and the strings and show you this chart right on the top, pulling the strings up and down. Okay. On that note, let us begin. So we have the live real-time situation going on. Asian markets have opened. They're just starting to get warmed up. Some of them are down. Some of them are slightly up. Chinese markets are going to open up full blast very shortly. They should be open right now. I'm checking on my other screens, and I do see futures which have still not started trading yet on the Chinese market. I'm not sure if they have. Oh, yeah, I'm sorry. They started 9 p.m. Oh, my apologies. They started 9 p.m. in 15 minutes. So I'll be, they were closed for a week for the Chinese national holidays. And now they're going to basically play catch up. So on that note, let me cover a couple of quick things here, which are very important. It was a very eventful weekend from a political U.S. governmental standpoint. Judge Kavanaugh was voted in as the next Supreme Court justice, and regardless of all the heavily sensitive situations that's going on regarding sexual assault and everything, which we obviously feel very strongly about, we all do, doesn't matter what political affiliations anyone is. Just overall, from a purely economic standpoint, it's a positive for the markets. Let me just leave it at that. Okay. So regardless of what one thinks about anything, the nomination of Judge Kavanaugh is overall a positive catalyst for the markets. Not that nomination of Supreme Court Justice make a difference, but given the fact that President Trump and the business administration and the very business-friendly policies that he has implemented since he got elected, and rightfully so. It is going to be a continuation of those policies when big business cases appear in front of the Supreme Court. And the story on that. The second point is that we had China, which is now coming back live in about 13 minutes, cut the reserve ratios. That is very big. China's economy is starting to show signs of weakness, slighter signs of weakness, because of the trade war frictions and the massive tariffs that have been implemented. After all, they need us a lot. We do need them on the supply chain side, in other words, the manufacturing side, but they need us a lot to sell their goods into our markets. Okay? It's a bilateral situation, as President Trump likes to say. Reciprocal, right? And bilateral. But, and so they have now cut the reserve ratio, which means that the amount of capital that banks have to hold in their vaults has been reduced. I don't have the exact numbers in front of me, but it has been reduced by a slight amount, not a radical move. Now, it's like cutting the capital ratio here in the U.S., where the Federal Reserve goes out and says, you know, J.P. Morgan or Goldman Sachs or all the big banks or Bank of America says you don't have to hold that much capital. Reserve ratios are important because it basically is the security deposit that the banks put in just in case something goes really wrong. They have cash in the back to basically not have a run on the banks. Does everyone understand what I just explained in very simple terms regarding the RRR or reserve ratio requirements?
Yes.
Okay, these are extremely important because when China does that, what they're basically doing, they are putting in, I believe, about $110 billion, according to my readings, quick readings over the weekend, into the economy. That's $110 billion of vitamin B12 coming into a person's, like a vitamin B12 shot, because somebody's starting to get starting to feel a little lackluster and losing energy or whatever the case may be. So the way you look at it is the Chinese economy is starting to lose energy, and it's a very vibrant economy. After all, they're the fastest growing demographic or the population growth in human history, right? So more people, being born, going up, more people buy things. It's all good. That's the way it goes. Economies and great nations die because the birth rate falls, and there is nobody else to consume the products. Companies don't have anyone to sell to. It's really as simple as that. We gotta have kids. That's it. So anyway, to make a long story short, $110 billion now has been infused in the Chinese economy over the weekend because of the cut in the reserve requirement ratio. Will that be an immediate boost to the Chinese market? Well, technically, academically, yes. We'll find out in the next 15, 20 minutes. And as the markets, Chinese markets open, they'll figure it out. They'll go from there. So, but that's overall a positive thing. So those are the main things that really happened over the weekend. The North Korea thing is also important. And I want to mention this to you guys because it is very critically important because of one line. Our Secretary of State, a fine gentleman, Mark Pompeo, like him a lot, okay? Ex-CIA director. After the North Korean meetings, which are going to be back and forth, obviously, now supposedly is heading to China to talk about the North Korean denuclearization prospects. Now, the way I'm reading it, if China and us are that much at loggerheads, friends do fight, right? So bottom line, and that's exactly really what's going on here, and we are business friends more than anything else, China and the United States, just the way. Somebody please mute their mic, please. I hear a lot of clinking glasses or whatever you're doing. Thank you. So, Okay, I'm not sure who it is, but everyone just maybe mute their, they should know how to mute their mic so I don't get feedback, noise. It's difficult for me to continue, when I get feedback noise. So, all right, thank you. So bottom line is that Mike Pompeo is heading to China, and I find that to be a positive. As long as we are publicly and internally, which we're certainly communicating with Chinese, there's no question about it, are communicating with our biggest trading partner, one of our biggest trading partners overall, China, and a very strategic partner. After all, China is a superpower. Let's not like joke around with about that. So, so bottom line is, it's a good thing. So the fact that our Secretary of State, fine gentleman, very smart. I like smart people, by the way. I really like smart people because I can learn from them. And not that I don't like dumb people. I learn from them too. But in general, I like smart people because I learn from them more. So Mike Pompeo is one of those individuals who's very smart. And the fact that he's going to, our Secretary of State, that he's going to be in China, hopefully in the next couple of days, is a very positive thing. Very positive thing. You think they're just going to be talking about North Korean denuclearization? No, they're going to talk about other stuff too. Something is going on. And the Trump administration, in my opinion, will deliver in between some crazy stuff that has been put out there. Stop. That's a poker game. All right. That's it for the macro picture. Oh, the biggest, one of the other macro pictures that I have to notify all of you as I'm flipping through the charts and you're kind of looking at it and like, these charts are not the first time you've seen them. They're put consistently on my real-time Twitter feed for you guys to navigate these markets. So, is the interest rate situation. They're making a huge deal that it rates our 10-year government bond, which is what I track primarily, and which is basically the root of all the interest rates that we pay, which affect us. What are they? Mortgage rates, car leases, credit card rates, bank interest rates, but those consumer rates primarily. What's the biggest expense that any American, or an average American had? Mortgage rates, which have been creeping higher because the 10-year government bond yield is right now trading at 3.225%. 3.225%. Somebody says, what's the big deal? It's only at 3%. Well, the big deal is it was at 2%, 2.5% just about 2 weeks ago. It is not how much it rises. It is the rapidity or the speed and the velocity of how it's moving. So when something moves up 10, 12% from the 2.5%, 2.9% level up to the 3.25% level, approximately, and it's moving up, that's 12 to 15% move, right? Percentage-wise. Not that our rate is 15%. In that case, we'd go into a depression. Not going to happen. I'm talking the move from the 2.9 level, 9% level to 3.2% level where we are right now, or 3.225 to be exact, where we closed on Friday. This is the 10-year government bond deal, treasury bond deal, the fixed income yield. Then that is rather fast. So what happens? I explained that in my previous video. I don't want to waste too much time explaining that in this video. By now, all of you should review that video and learn the basics. Because if you don't understand these basics, which is like number counting, it's like kindergarten or first grade, you're learning the numbers, like 1 + 1 = 2. So in the markets, if you don't understand these basics, that 1 plus, this is the same thing as learning 1 + 1 = 2. I know, which I've always complained about, that us Americans in general are basically complete idiots when it comes to understanding basic economics because our system doesn't teach it. Just the way we're complete idiots because our system, most schools don't teach kids coding, which is the same thing. It's learning 1 + 1 = 2. Because 10 years from now, if you don't know basics of programming and coding, you are not going to go anywhere in life. Nowhere. So, bottom line is, when it's not, I repeat, the velocity. I mean, it's not how quick the charts, let me put it, the 10-year government bond yield's moving, where it's moving to, yeah, which does make a difference, but how fast it's moving, right? It's like a quick acceleration on your car and you're losing control on a rainy day. So you need to go slow and steady. It's the same thing with stocks. If a stock shoots up like crazy, there's going to be profit taking. But so what this has caused is disruption when yields go higher, and please review my previous video for this stuff, that I do have to say this now, is the fact that when it moves higher that quickly, bond prices fall. Bond deals move higher, bond prices fall. They're inversely correlated, opposite. So when bond prices fall, like a stock price falling really hard, what happens? Panic selling, big time panic selling, margin sellouts, and you think you're losing your shirt completely. Same thing with stocks. You sell at the lows. So people, the rookies in the bond market are doing the same thing. They're being forced to sell as yields are shooting higher. The price of their bonds are falling hard. And mom and pop still doesn't realize that they can lose money in bonds. So that's a dangerous thing. Because most of the money that has gone into the market over the last 6, 7, 8 years has been where? In fixed income or bonds. Because anytime you say bonds, what's the first thing that comes to mind? Safety. Yes, U.S. government bonds are safe. There's no question about it. This is, by the way, the 10-year Treasury index, the actual interest rates, what we call yield in the case of bonds. So 32.25 doesn't mean 32%, guys. You move the decimal point to the left one. So basically, it is at 3.225%. Or if we want to round it up, it's basically approximately 3.23%. So somebody might say, hey, I lived through the 80s when rates were, Jimmy Carter's time. We were like 15%, 17%. You could get a mortgage like, at like 14%. Now mortgages have moved up to like 5%. So what's the big deal? The big deal is basically something much more psychological and also somewhat cognitive in the sense that you went from getting mortgages at 3% to 3.5%, right? Which were just about last year. As rates move higher, now you're paying 5%, 6%, maybe 7%. To get a mortgage. People are like, oh my God, the world's falling apart. No, it's not falling apart. Can the market withstand a rate rise up to the 3.5% level, maybe 4% level, which I call it a kind of a threshold? Over 4%, things get a little bit crazier. Yes, absolutely it can. Absolutely it can. U.S. companies have the most least leverage. What does it mean in simple English? They have the least amount of debt overall in the last 20 years, 30 years. Why? Because they've been buying back their debt. They've been buying back their stock. They've been paying down the higher interest rate stuff that they might have borrowed 20 years ago. They're flush with cash. Our banks are fully capitalized. A lot of good things. But they won't talk about that. Because the media likes to talk about all the bad things that can happen. And it's not just the media. It's a lot of big shots who come on and scare the living daylights out of all you guys. Because they talk, this is like 1987. Are you kidding me? 1987. I don't even want to go there. This is not 1987 when the market lost 22.5% of its value in one day. And after that, it never looked back and went higher and higher and higher and higher. But that's not the point. This is not 1987, but the bears love to talk about that stuff because they want to make money. And how do they make money? They short the crap out of the market on every little move that happens. Most of the times, 90% of the times, they lose money because the market goes higher. But sometimes in corrective situations as we're going through, they make some money, so they want to talk their book. They want to keep on spreading the lies. I mean that. They keep on spreading the lies, the fake news about the U.S. economy being weak and all that garbage. And a job report like, oh my God, that's going to end the world. Or a rate moving higher to 3.5% is going to end the world. 10-year government bond deal, as you can see here, hit 3.248%. This is a short-term chart, and this is since, bear with me one second. Okay. So they just want to spread fear. It makes me sick, but hey, that's life. Everyone talks their own book, I guess, right? I'm overall bullish. I believe the U.S. economy is in fantastic shape. And the global economy, which has somewhat been a little bit jittered with all these trade war shenanigans going on, is still in very good shape. So, saying all that, I'm not a crazy bull, but there is nothing really fundamental that's wrong with the global economy or the United States of America, economically speaking. Do we have nasty politics? Absolutely. That's just standard procedure. It's a democracy after all. So saying all that, I'm talking about the economic front. Okay, so looking at this 10-year chart, this is a very important factor thing. This is a 15-minute chart. This I charted exactly like I chart stocks, and we want it to ease back because this is what it looks like on the daily, right? And I charted this a long time ago. There. So on the daily, on the weekly chart, by the way, it looks like it is starting to top, just like a stock. I want you guys to follow this very, very clearly. It's very important because as rates, when rates go, we're having a rate tantrum, right? Like boom, rates are going higher. Great technical chart. Stocks are moving higher. We're taking some profit. We're buying something. Boom, market falls. So remember, stocks and bonds, they're all correlated. I told you, big margin sellouts, bond prices drop really hard, yields shoot up higher. And everyone's just like, oh, this market really sucks. We can't make any money on it. Well, we are making parts and bits and pieces of the very decent money, but the technicals keep on pushing down intraday because bond price, because they're making a big deal out of bond deals going higher. So looking at that, bond deals look like they're gonna top at around 3.4% based on the channels, and worst case scenario, they're going to base at 3.8%. Well, if it hits these levels, you can rest assured the markets, the stock markets are going to fall more, and anything that we have on the long side is going to fall. So we have to monitor this very closely. As tactical traders, we remove emotions from the picture. We are looking to see, okay, this looks like it wants to go higher, but what is happening on the short term? Remember, this is a weekly chart. The difference between a weekly chart and a trader's 1-hour chart or a 15-minute chart is that you can make a lot of money scalping short-term positions within a short period of time during the day or within 1 or 2 days. Every time I do a webinar, I say the stock is going to go here, it goes there. Now, if you're not reacting to that position, taking money off, and then we scale in and buy a little bit of our other position, and that goes down at the end of the day. The following day, boom, it goes back to the similar level. You gotta, it is, after all, a very robotic trading market. And I wish I could change it for all of you and for myself and say, okay, my charts are going to go exactly the way it is within 24 to 48 hours. But it doesn't work like that because within that 24 to 48 hours, my charts hit those exact levels and then pull back. And then it does this and then goes up and then pulls back. That is called volatility. Nothing we can do to change it. Is it easy? Absolutely not. Do I like it? Absolutely not. But life, in my 50 plus years of my existence on earth, thanks to God, okay, that life is not a straight line. Walk in the park. A happy life, a successful life is through a lot of trial and tribulation, a lot of hard work, a lot of sadness, a lot of potholes. But you know how to navigate them. You arrive at a point where you're happy with yourself. That is what makes a trader a successful trader. Net. Same thing, guys. Same thing. So, say without all the philosophical ramifications of what I just said, which everyone can relate to, bottom line is, let's take a look at how we can make money of the fact that these rates are going higher. We most likely will hit 3.4%. What do we do in the meantime? So what we do is we look at the 1-hour chart. This is what we do in the meantime. So if you look at the 1-hour chart, and I'm just going to draw some basic. We have a rising wedge. Whichever way you draw it, it's a rising wedge. What happens to rising wedges? I know most of you know the answers. People stay with me. Rising wedges basically have a consolidation. They go up like this, right? Just the way this is. And then they consolidate. What is consolidation? It's simple English. It means profit taking. So the people who shorted the bond market on the bond price side, they will profit take. And that is about to begin. Might be very quick. Might be a couple of days, getting towards the middle of the month when we get that big turbulence. So the profit taking is right now being seen in real, as you can see here, with a red candle. Can it turn around and go higher? Sure. But I'm giving you what the normal probability is, because after all, trading is about probabilities. So if it does have a, let's do this right, okay? So here's your rising wedge. Profit taking comes in. The guys who shorted the bond market says, "Oh wow, we just made a ton of money." Remember, they made it, but this is not a bond price thing. This is the yield part, right? So let's say they shorted the bond at like $80. Just giving you a hypothetical example. Now it's down to 60, right? So they're up 25% on the money. Don't you think that just shows on their paper they want to cash it? So they sell it. That's short covering. So bottom line is that if we do get a consolidation move on the bond deal side, remember, we just simple part. I know a lot of you don't understand like the bond economics of this thing here. We want bond prices or yields or interest rates to start to ease back, not crash, ease back, come down. We don't want it to go up. We want it to go down. Is everyone clear on this part? Okay, I'm not Jim Cramer. He's a lot richer than me. But when it comes to intellect and knowledge, trust me. I have taught some of the biggest of my ex-clients, institutional and retail net worth, big money, to understand basic economics that they never bothered to understand or learn. So I'm doing the same thing with you guys. Very smart people. All right, so I want you to understand this. So basically, we want bond deals to start to pull back, bond interest rates, yields to pull back a little bit, ease back, and not just shoot higher. Remember, it is the rapidity of the move, or the velocity, is what scares the markets. It's like a stock crashing really quick. We want it to, if we want bond deals to go higher, sure. We don't want to be stuck at 3.5% all our lives. That means what? The U.S. economy is not growing. We want it to go, but we want it to not move like this. We want it to move it at a angle, maybe at a 30-degree angle, not like a 45-degree angle, not like a 90-degree angle. You understand? We want it to just go up like this. We don't want it to go up like almost like on a 60-degree angle. You understand what I'm saying, guys? So, technically speaking, bond deals right now are starting to ease. This was Friday. Just like a stock, you look for the next point. All this stuff, by the way, I teach you in my advanced coaching sessions. You can do this with any asset class. These are tools that I teach. You can apply and make and basically be independent, control your own trade, your own destiny. Despite all my guidance and suggestions that I put during the day. So it can come down to 3.18% because you can see here clearly there's a gap, and this is where it kind of broke out of. So if the bond yields fall from 3.248% to 3.18%, what do you think is going to happen to the stock market? Somebody please answer.
If the interest rate goes down, the market will go up.
Okay, did everyone hear that? And everyone needs to understand that. All right, absolutely. It's not interest rate. Yes, exactly, interest rate bond deals. If they ease back, the markets are going to go berserk. I mean berserk. They'll be up 300-400 points in a flash. We have seen that happen many times before. Okay, exactly. So if we drop from 3.248% down to 3. Remember, you have to move the decimal to 1 point. That's pretty obvious. Anyone who doesn't understand this, is a real mental problem because we're not at 31.8% rate. We're at 3.18% rate. So 3 point, we're not Zimbabwe here, okay? So 32.48 minus 3.18 is a drop. Oh, 1 second. Bear with me 1 second. I'm going to give you exact percentage drop. So that is a drop of roughly 2% on a percentage basis. 2% drop from here to here, okay? It's like a stock falling from $32.48, very simplistic terms, or $3.24, whatever, to 31.8 cents. From a stock falling from $32.48 to a stock dropping to $31.80. That means the stock has dropped 2%. That 2% drop on 10-year government bond deals will shoot the U.S. stock markets higher anywhere from 100 to 300 points. If you're not set up for that move, futures are up about 3 right now. I don't know if this is happening tomorrow or the day after, but I'll tell you, if you're not set up, which some of you are doing a fantastic, I'm so proud to see some of my members attacking the tactical lows in the market, which is what we're going to go into right after this very important and critical and pivotal understanding of the bond markets, okay? And how it affects your money in your pockets, how it affects you being a trader or an investor. So if you're not set up prior to that, you are never going to recoup your portfolio, your losses, never going to make money, ever, period. I'll just say that clearly. You know I don't bullshit. You always have to be set up slightly ahead of the game. Because when the markets are running up 100, 200, 300%, it is very difficult to jump into, and we do it, I know, but it's very difficult for a lot of people out there, my members included, to jump onto a running train. Yes or no?
Yes.
Absolutely. And that's exactly what idiotic retail emotional traders do. They don't look at the charts, they're just running after prices. And then what happens? The markets move higher, then they consolidate. Bang. They're done. It happens all the time. Now, does it excite us when prices move higher on something that we own? Absolutely. But the algorithmic high-frequency trading programs have a trap. They always trap human traders. They know exactly at one point where they're going to get excited and say, buy, I'm going to buy, I'm going to buy. If they're just watching price and not the charts. I'm not saying you can't jump onto a fast-moving stock. We've done that so many times in so many things. But all I'm saying is you got to look at the charts. If it's overbought, if the stochastics are way overbought, you got to watch out. So that's it. That's all about what I'm going to explain to you. And then if somebody really wants to understand all this stuff and incorporate that in their strategic trade management, remember, it's not where you get in an option or a stock. It is how you manage it is what makes you the money. I repeat, it is not the price you get in a stock or option. It is how you manage that trade is what eventually makes you the money. And that trade management skill, 99.999999% of retail emotional traders and other traders, but we are dealing with human traders here, have absolutely no idea. Partly, mostly, not their fault, but partly their fault completely because they refuse to learn the skills. And I try to help them as much as possible during the day, in the chat room, in my real-time Twitter feed, which are extremely precise, in all types of markets, and through my advanced coaching sessions. But many just don't care to learn or sign up for the ACS and stuff, and they suffer over and over again, like a drunk who doesn't want to give up drinking. End of story. All right, let's move on to stocks now. So I believe that we are going to, before moving to stock, I believe that we're going to start to ease back. You can see that there is a massive overbought condition that is continuing. Overbought conditions tend to resolve as oversold. And if it does resolve as oversold and we come down here, we're going to have a very sharp, powerful rally. This was your breakout level, just like I tell a stock and just like I explained. What did we do over the last 2 days? We came back and retested our breakout levels. That's all we did on the stock market. And by now, you guys know that because I've shown multiple charts on that. Well, just the same thing with government bond deals. They will test at some point their moving averages, the 20, the 34, possibly the 50. If the bond yields fall from 3.248% down to 3.1%, you will have a 600 to 700 point rally. And banks also will participate in it. Even though banks do like higher rates, they don't like runaway higher rates. Okay, that's it. All right, let's move on to stock charts right now. So the stock charts we've been using to navigate these type of markets and scalping 60, 80, 100, in some cases 120% on reversal trades. I am not. I am doing some very quick short trades on my side. I am not recommending them because they're so fast. Okay? So saying all that, I leave it to members to use these charts as extremely precise GPS navigational guides. If they want to short on a big break of each of these levels that I've drawn, feel free to do so. And I repeat again, as I said in my previous video, the reason I don't recommend any type of large scale or mid scale SPY or SPX or QQQ shorts and such is because they are so fast. When they're this oversold in so many ways, and this is a 15-minute chart. This is just showing you intraday movements primarily. But on the long-term part, they're like a coil spring. And what does a coil spring do? It just pops up. So I cannot bring myself to putting out a trade on the short side and then somebody's not watching the charts. They're waiting for my alert to sell. And before I could even move, the thing turns around and goes higher and they lose money. So what I recommend is for active traders, and all of you are smart people, God has given us brains. If you do want to short this type of market at these extreme oversold levels, then please do it on your own intraday. And some of you do. And it works. I do sometimes on my side. Because remember, I'm a professional trader. Learning every single minute. Never stop learning. Never stop learning. Trust me. I'm talking about myself. I never stop learning. And that's what I share with you guys, ladies and gentlemen, is the fact that I do other trades too, which have a lower probability but give me some very nice returns because of the market's structured volatility. And I don't post them because my book is different than your book. But most of the trades, I would say 90% of the trades that I'm putting out there, I'm there in it. But some of them you guys got to manage. So just want to make that clear. I'm sure you guys understand. Okay, so this roadmap is pretty clear. Look at the broader picture. So I'm going to paint it with the large brush. We were in a we were in a pretty volatile trading range. Going back to the end of September 26, 27. We can clearly see that multiple opportunities to make money. Not easy because the markets are very choppy. They open up. I tell people to buy at the end of the day on deep oversold conditions, which are in most cases marked. Marked by these arrows. I don't know why I even do that because you should be able to see, this is pretty common sense that when that's oversold, it's right there down here below 20 RSI, the stochastics. So you need to be a buyer. And then the next morning markets pop up. Nice profits to be had by 10:30. We're out of the market by 9:40. Well, those tactical trades, 9:45, maybe 10 o'clock, and then the market starts to ease back. But that's not a constant norm. The market's fluid. It's constantly changing. But that's what it did over the past week, 10 days. So saying all that, I structure my charts for you guys to take advantage of. So we were in this broader trading range, which was between 29.35 2940, you can see that, and the base level of 2905 or 2907. Pretty wide trading range, because 2907 to 2940 is 33 points. S&P points or E-mini points. So 33, the conversion rate is roughly 6. Every E-mini or S&P point is 6 to 7 Dow points. So 33 points is approximately 220 Dow points. So this was a 220 Dow point type of thing. Then we fell below that. Then we went, And again, I'm not making light of it. This is not an easy market, guys. All right? But I don't know when the market's been easy. Even when the markets were flying through sky high, a lot of you weren't even were making money. So, what can I say? It's not a bull or bear market that makes the trader money. It's how a trader reacts to those bull and bear markets that makes a trader money. How many times, I showed stocks which have gone up 100, 200 points in the past 3 months. And how many of you have capitalized on most of it? Very few of you. Okay? So it's not a bull or bear market. This is my quote of the year. It's not a bull or bear market that defines your profits. It's how you manage your trades, and it's how you react to the charts that I put through is what defines your profit and loss statement. You can have the most rampant bull market that we've been having since 2009, yet 90% plus of traders have not made money. It's true. We have had the biggest bull market since 2009 in between massive corrections, yet 90% of traders have not made money. Even in the past 6 months, even though stocks have gone up like this, and now they're correcting. So even through this, very few of you have made money. And it's not just you, it's overall. Because every time the markets went up, they're, oh, it's too high, it's going to crash. Because they never looked at charts. Rely on the charts, guys. So I repeat again, it's not a bull or bear market that defines your P&L, profit and loss. It is you, how you manage your trades, that defines it. The ones who don't want to recognize it, either drop off, quit, or just say, oh, I'll come back at a later time. Well, good for you guys. Remember, the lesser amount of traders we have in the stock market, retail traders, the better off we will do at Cludesay Trading. We want the least amount of participation by human traders in order to make the most of our profits. We want people to be scared, like they say in New York, scared shit, terrified of bull markets and bear market. Long and short moves in the market. And that's where we capitalize. Believe me when I tell you. Now, that doesn't mean we just need 1 or 2 members left over at Cludesay Trading. All right? We don't want that. We want everyone to participate. But generally speaking, when I see certain amount of people dropping out on a certain week, I know we are at the cusp of a pretty big move in the market. Always remember that. It's behavioral finance. So looking at this 15-minute chart, you can see what's going on. It's pretty clear. This is a wide downtrend channel. In between, we're moving fast and furious. And at this point, this big fat neckline, which we broke, is now a big fat resistance. And that is roughly about, we are at 28.98 or so right now, 28.97. So that's roughly about 10 points from here. So we always have to watch the reaction. Now, that's the neckline. The next level of major resistance, I have drawn out, 29.15. Now, many of you trade the SPYs, which are very cheap to trade, 30, 40, 50, 60 cents. They go up to $2, $3. Or if you short them at 40 cents, they can go up to $2 if you catch one of these moves. SPYs are a great way to trade the market. So, or the SPX. SPYs are cheaper. So, bottom line is, this is pattern completion is on 29.15. And you can see that clearly. I showed this in the last webinar when we were down and it hit exactly that. And boom, comes the flash crash. These flash crashes are getting extremely annoying. Okay? Because a lot of it is coming from Europe. Part of it, emerging markets, some of it coming from emerging market through Europe and hits our shores. And then we get this selling right after like 9, sometimes 9:30, sometimes 9:45, 10 o'clock. We can't do anything about it, guys. The only thing we can do is we can monitor these charts and manage our profits. So saying all that, this is where we are. So this is pattern completion. If it gets towards the 29.16 level, I keep on showing this chart quite often, you better be taking your profits. You better be taking your profit. Doesn't mean you need to short the market. Because remember, right when everybody's shorting the market's going to explode higher. But each of the levels where it can go to is like a gap fill here at 29.24. Everything is shown out. Nothing more to explain here. Overall, the overall downtrend is not broken out till we break out of this level here. So I monitor this all the time and I share it with you guys. Let's take a look at the hourly charts. The hourly charts are this right now. This is going back to August 24th, where we had an impulse breakout level. Now, I put that word in there last week, I think Thursday or Friday, because this was a very large impulse breakout. Impulse breakout was something that happened impulsively. You don't understand the word impulsive, please look it up on the dictionary, all right? So, it just happened. Impulse. So, impulse moved happened. Somebody please mute their mics. Thanks. Impulse moves higher. We basically came close to that, and we came close to that. I thought we were going to check the 28.64 level. We might very well do that. We might very well do that in the first 20 minutes or the first minute the market opens, because that's where it was on the 7th of September. I'm prepared for it. I am prepared for it. Can we break down to 28.45? That's a low probability move, because the markets have taken quite a bit of beating. And right now, this is the way I look at the market, with this level of 28.65 as a major support. You can see the pattern. A lot of volatility here. You can see that. Let's start erasing part of the noise. Let's start looking at the daily. Now this is like sitting back, taking a deep breath. Take a deep breath, everyone. Like, and you know what a deep breath is, right? A yoga type of breath. And I'm not a yoga kind of guy, all right? Do I know a lot about it? Sure. You take a deep breath till it goes into your guts, into your stomach, and you let it out. Okay? Not just a short breath that we all take, where our body's not getting nourished. Take a deep breath, feel it in your guts, and then exhale. So this is what it is, the daily chart. The daily chart keeps you grounded, away from the noise of the hourly and the wild noise of the 15 minutes. This is your daily charts. Exhale. Let it go. Take a deep breath. I'm serious. I tell my wife, she goes, shut up. I'm like, honey, do it. Whether you're running, whether you're brisk walking, whether you're playing a sport, take a deep breath till you can feel it inside your internals, your stomach, your guts, and then let it out. Do it 8 times, do it like, do reps of like 8 times every couple of, let's say a few times a day. Tell me if it makes a difference to your mental state when you're trading. Trust me. Come and seriously tell me. All right. I'm not your yoga instructor. I'm your technical charter, but I'm telling you some real aspects of life. Okay. Breathe. Real breathing through your stomach and then out. Good. Now, take a look at this. This is your daily chart. If you look at it, nothing really wild has happened. Yet the world is falling apart. Because we are, after all, options traders. So our world does fall apart a bit when these things happen. But let's take a look at the bigger picture. We do have a massive support level at 28.64, signified in red here on this line. This was the same level that the markets bounced off on the previous consolidation. Each of this bar is 1 day. 1, 2, 3, 4, 5, 6, 7. 7 days in a row with little bits of quick up days and stuff, but overall 7 days in a row, starting on the 30th of August. Look at the date down here. Starting on the 30th of August, we came down. That was a 7-day consolidation. And all we did was retest the bottom of this blue channel, which is the acceleration channel, and well above the big macro channel. Remember, if we had broken this big macro channel, then we knew we would have come down to 2,800. So that was 7 days in a row. Here we have 1, 2, 3 days. And this is where it turned from, on the 7th of September. So let me zoom in. Remember, this is 2018. This big fat thumb here is not a cartoon character here. This is 2018, how it started. We broke out of the ascending triangle right here, this beauty. We broke out of that, which I said we would, and we did real well in that because we were all set up all through the way here. Each of these lines down are consolidation, profit taking. 1, 2, 3, 4, 5, 6 days. This one was a longer one. This one was a short one. 1, 2, 3. This one was 1, 2, 3, 4, 5, 6, 7. This one was 1, 2, 3, 4, 5. You have to know this stuff. So 5 days of selling. So now we have this. So this is a very critical level, as you can see, and I'm going to zoom in right now. Okay? That's why I put a bull kill zone here, because at this point, the markets are just going to be freak out. So is this level here, 28.65. Now, what did the markets do? You have like I was showing you, you have this big ascending triangle breakout, right? You guys can all see this. So this is a major support level, major. And that's exactly what the markets did on Friday. And you can make money off this stuff. Because that reversal candle was good for 60 to 80% on some nice SPY or SPX trades, or trades on multiple stocks, which bounced 3, 4, 5. Amazon bounced 22 points. Apple bounced 3 points almost. You can make money off that stuff. You're a trader after all. Now, if you're too busy to trade that stuff, I fully understand. I'm not in the business of telling you what job you need to do. But if you're too busy, then don't bother about some intraday stuff. Just stick to the daily charts. Buy something 2-3 weeks out and just sit there. Just don't watch the daily, the 15-minute, 1-hour charts and look at my charts when I'm showing you the bigger picture. But humans don't do that. Everybody's thinking long term, but everybody's freaking out like a monkey on a hot tin roof every 10 minutes. Right? So you can't have it both ways. You want to be a swing trader, lasting a bunch of days, a week, then you can't be a 5-minute, 15-minute trader. So look at this. So this was important. We hit that neckline right there, this green line, and look what we did. We slipped below that, and bang, we turned around. That was a pretty big move. That's when the markets went down. We were down 300 some points, and we ended down 100 some points. That's a lot. So it's a Chinese firecracker. Is it the most powerful bullish hammer? I mean, this is known as a hammer reversal, right? Like a hammer. You can see that. I call it a Chinese firecracker. Look at that. Is it the most bullish one? No. But then it happened here. This is called pattern recognition. This is what we specialize in. So we don't freak out when all of you are freaking out. We stay calm. We breathe. And we set up positions. We're like the hardcore SEALs. We're like Delta Force at Cludesay Trading. We don't freak out because the frigging enemy is bombarding us and there's only 12 of us left to take them out. That's the difference between Cludesay Trading, tactical traders, and the rest of the retail emotional junkies out there. Fact. So, this happened on the 7th. Look carefully. This happened on the 7th. I'm sorry, the 15th of August, right there. See this candle? Just like this. Exact same pattern symmetry. Pattern symmetries there's no rule saying we're going to exactly do the same pattern in reverse and go higher. No, but you have to acknowledge it. Look what happened. And then the market's moved. Can that happen? It sure can. Now, what do we look at? We look at the basic internals, and the internals are quite oversold. Here, we are very oversold. Can we slip down further and retest again the ascending triangle neckline breakout? Absolutely. Absolutely. The stows are not fully crossed over yet. You don't need to know anything about technical analysis. You just have to know these basics. The basics. Either you follow my arrows on my short-term charts and my longer-term charts, but on the short-term trading charts, or you understand a little bit of this. It's both equally powerful. So we haven't crossed over like that, but we are quite oversold. We could do this, or we could cross over here. And if we do that, this thing is going to move. Now, on the daily charts, if it starts moving higher, and we create a bullish engulfing candle. This is what a bullish engulfing candle looks like. And I'm not going to explain to you candlestick dynamics because it's on my YouTube channel on the new member introductory video, as well as a playlist. I believe it's called Candlestick Patterns. No, it's actually under new member intro videos. Go listen to it. There are 2 major videos on that. Because if you don't understand candles, you are a bona fide, well, just call yourself any name you want. It's not that hard. I can teach a 6-year-old this candlestick dynamics and they'll pick it up. So, bullish engulfing means that, well, I'm not going to explain it. I'm like saying I won't explain it. I'm still doing it. Well, you can see it. The body of the candle is bigger than the previous red candle. So what happens here? What happens if we get this by tomorrow? That sets up for a multi-day rally. Is it going to be intraday volatility like this along the way? This is intraday. 1 second. Like this, as it's moving higher? Absolutely. Absolutely. You think every minute the candles are going to expand? No. Wake up. So that's why the daily charts are important, because they are telling me if this green candle is going to expand, and while it's expanding, it'll be doing this stuff. Now, what does this mean to your portfolio? It means that if you bought an option at 4, it's going to be at like 2.5. It's going to be at 3. It's going to be 4.25. It's going to slip down to 3.5. But it will go higher if, and you're going to sell it at double on your money, if this candle keeps on expanding during the day and remains solid green. This is the most important, one of the most important things you guys need to keep in mind. When I'm showing the daily charts, and now you can replicate these things easy on your side. After all, you guys have a platform, okay, on your side that you can pull this up. And this investing.com is free. Go in there. You need some help setting up these charts? I'll give you a couple of minutes to explain, to help set you up. Or if you sign up for the ACS, you can really set up your charts in the right way and don't land up in a ditch every 15 minutes and do stupid things. So if this candle keeps on expanding green, then you know something's going right. In the meantime, there's going to be a lot of volatility in the middle, as in the short-term picture that I showed you. And if we can cross over the consolidation channel here, remember, this is a consolidation channel. We are still, believe it or not, through all this madness, well, we slipped below the consolidation channel. We slipped below the macro channel, but we held this level here. That is critical, this level. It's very critical. I was waiting for that, and it happened. I said, thank God it happened. And if we can cross below, we re-enter this macro channel right there, this macro channel here, which is around over 2907. Then we have a fair shot to go retest, to re-enter. Remember, the blue lines here in between this big channel is your acceleration channel. This is the acceleration channel. This is where the markets hit pedal to the metal. I'm sure some of you have driven fast sometimes in your life. And if you haven't, then certainly do it. Find an empty stretch of the road and hit the pedal to the metal, okay? Because trading is exactly about driving. Trust me. Not as much about flying. It's about driving. If you drive a high performance car, you know you got to change, gears real fast, so you don't land up on wrapped around the tree, or any car for that matter. Now, if you're on autopilot all the time, well, you can't really. Even then, hit the gas and try to navigate the twists and turns in a road. That's trading. So bottom line is, if we get up here, then and we break above this consolidation channel, we have a shot to hit that level again, which is the all-time high. And we'll see what happens along the way. So the overall picture on this is we were consolidating. We need to pull up. And we need to pull up from these levels. Even if we slip and slide a little bit at the open tomorrow, we need to basically start pulling up. So that's it. This next chart that I'm going to show you is, this is also a great trading chart. This is not real time right now because it's not a futures chart. It's the actual chart of the S&P 500. It's very clear to see. I like this chart a lot. A lot. Why? Because it's not futures. Remember, what futures happen on the Globex futures actually means nothing, right? We know that. By the time European markets open, by the time our markets open, it means nothing. So, give me 1 second, please, guys. Okay, and bottom line is that if you look at the pattern here, it's much more easy to see. This is it's kind of a very large falling wedge, but even it's a downtrend line, so this is going to be pretty major resistance, just like the previous ones, around 2904, 2905. Best case scenario, we get a full blast in the market, we get to 2920. That's a very decent sum of money. And remember, this is not just for SPY or SPX traders. This is for anybody who's trading any of the fast-moving stocks. So once it hits that, you want to be taking or getting close to it. You want to be taking your profits down, because by that time the stochastics are going to be fully overbought. This is not rocket science, guys. This is observation and managing your trades. So this is a much more cleaner chart, and you can see that right there. This I like a lot because it's a double bottom stow. Not much to explain here. Generally speaking, a double bottom stochastic, we have to base this on previous pattern symmetry. A double bottom or multiple bottom generally tends to have a more powerful rally. A double bottom stochastic bottom, right now we can see that happening, generally means that we are going to basically hit this zone here. This is very productive. That's your 1 hour chart. You can use this as a trading roadmap. Obviously you can. And remember, 2920 is extremely important also because that's where we broke out of on this ascending triangle. Remember what ascending triangle is. Go study my chart pattern analysis. Go on YouTube, learn patterns. Again, a 6-year-old can understand technical patterns. They can, because this is not rocket science. Rocket science is what Elon Musk does, what Jeff Bezos does, okay? We are a bunch of simple idiots who need to understand patterns, period. We're not rocket scientists. We're not Sundar Pichai of Google or Sergey Brin. We're just simple folk who try to trade off the brains of those great people out there, those people who make America great, to be honest with you. All right? So all of us as clueless idiots need to really sharpen, not me as much, but a lot of you need to sharpen your skills at understanding basic technical patterns. Thank you. So ascending triangle is just that. So this was an ascending triangle right there. That ascending triangle broke out. came back and retested, broke below, broke out again, came back and retested, created a flash crash, called a rate tantrum, right? The interest rate, the bond deal's going overshooting and stuff, the bears, hardcore bears, slimy ones, liars, I call them, come in and spread fear, like, oh my God, the Trump deficits are going to kill the market, blah, 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 all kinds of stuff. Remember, Chairman Powell didn't say anything that radical about rates. And they said, oh, he said something that caused them, no. Saying all that, so this is where we are. And this also is ascending triangle breakout, the 2920 level. So if we get there, there's going to be a lot of profits to be made on the setups that we did on Friday. And I hope it happens. I hope it happens fast so we can take it down. This is a market to trade charts. This is not a market where you sit back and say, oh, we're going to hit a new high. No. Oh, we're going to crash and burn and go down 10%. No. It's a market where we trade between ranges and tactical patterns as clearly shown on my charts. There's nothing else to it. And in between, the volatility frustrates us. There's nothing we can do about it. This is the other chart, which is the S&P 500 daily. And this I like a lot too. Why? Because it's really starting to bottom. Now, can it slip and slide a little bit more? And scare the living daylights, which I've already done to most traders, but really scared them to the point where they're like, that's it, I'm never going to buy a stock or an option. Okay? Yes, it can. It can go down to minus 0.32 like it did back in March, which created one of the most ultimate trading bottoms that we took advantage of. And very few people out there did, because the markets just roared, created a higher low and roared. I repeat, 99.9% of retail traders made no money on these run-ups. It is not about the bull market or the bear market. It's how you manage your trades that what makes you a successful trader. Never forget that. Write that down. So this is pretty good. We're getting there. And will we slip and slide and go a little bit lower? Yes, can happen. We could do that retest again. That's another 100 points down. There are still margin sellouts to happen. I don't want it to happen, but it can. Could happen as early as Monday. And then we could have that Tuesday turnaround. So you have to always have some cash on the side to deploy. And if you have a smaller account, no problem. Then sit tight on things that you have. Because one way or the other, this is going to resolve itself to the upside. No question about it. And that upside means we're going to come back and retest the 2940 level. We're trying to get back into this zone here. Into this zone or above this line. So that's a lot of money on the long side. And on the short side, I believe that if the market breaks this gap here at 2873, the markets are going to fall very quickly to 2800. That means another 400 points. So we certainly want to be short on that type of thing. But given the fact that we are so deep oversold right now on the daily, the chances of a quick reflex bounce to take us up towards the 2916, 2920 level, which is a very decent sum of money on the SPY calls and stuff that I recommended. That's like anywhere from 200 to 250% on those. Those are big numbers. Just to at least get attempting the re-entry phase. Forget about being successful. Maybe we won't be successful. Maybe the market does want to go down and retest the 2800 level. Seriously. Sure, it can happen. Maybe there is a massive escalation on the Chinese side. And Pompeo comes back from China and says, those guys suck. In his, in diplomatic language. Maybe companies start warning. Say, hey guys, good job. with heavy-duty tariffs on everything Chinese. We're just hurting our profits big. Markets will go down 300, 400, 500 points in minutes. Earnings seasons are coming up, right? It's starting next week. We need to know what great American corporations are going to say. Remember, it's business that made America great, not big political slogans. It's American business that made America great forever, since day one. And business sells a lot of stuff overseas. Now, the good news is that companies like Boeing and stuff that I mentioned weeks ago are still doing great. So that means, and Boeing, who does Boeing sell to? They sell to Mississippi? They sell to Southwest Air a little bit? No. Their biggest customers are the Asians, the Middle Easterners, not even the Europeans. Europeans have like crappy fleets. It's the Emirates, whatever, what is it? United Emirates, the airlines. It's Saudi Air. It's China Air buying these 767s and God knows the Dreamliners. They're the ones putting the money in our pockets, in our workers' pockets. All right? So time to wake up and smell the coffee. So the fact that they're doing pretty good is a good sign. It's a good sign. Because Boeing's CEO, what's his name? Something Koff? A brilliant guy. Brilliant. John Deere, one of our biggest winners on the swing trade. They're doing fine. That means they're buying our soybeans and our fertilizers and our tractors. So that's it. Now, I'll answer a couple of quick questions on individual stocks. Remember, here's the caveat. Okay, here's the warning. Doesn't matter how powerful some charts look. The twists and turns in the market are nowadays significant, random, with no sense sometimes, and so you guys have to keep that in mind. So it doesn't matter, what I show. You have to manage your trades in between the ranges or whatever they're coming through. So I have a couple of minutes. I want to keep this reasonably short. Tell me any particular stock that anyone wants to see, please. Walter, anything in particular? Tell me. I'm liking the fact I'll show you Apple, okay? Because this is a leading stock, right? It's a leading stock. So the daily stochastics are starting to turn, so that's not good. However, if we look to see overall the trend, please, somebody please mute their mic, please, or I'll mute them. I muted them. Okay. Is they are all hitting these big uptrend lines, 34-day moving average, 20-day, and they're creating hammer reversal. That's a good sign. That's a good sign. All right. So being a leading stock, this 2 days of selling from 233 down to 220, we traded this very nicely from 220.64 to 224. That's more than a double. That's about 160% plus on your money. So Apple, it's good. It's good so far. But again, it's a leading stock, and it's holding the major trend lines, so we're good to go. Boeing, forget it. They're beautiful. And don't forget, I recommended Boeing here. I recommended Boeing here. I recommended Boeing here. And I wish I had a heck of a lot more of Boeing, so I didn't have to worry about the goddamn volatility in the market. Now I'll be the first one to say it. So Boeing, if I do the Fibonacci retracements, this is where it broke out. Where can it go next? $404.25. That's the Fibonacci extension, 161.8%. Boeing right now is a bull flag. We get one speck of good news out of China, one speck that we are at least saying hi, and saying shishi. What's that? Thank you. Yeah, my son took Mandarin in high school, so, and he hated speaking Chinese. It was the toughest thing he ever did. I think he got a B+. And he was just like, Dad, I'm so glad I'm done with it. Because it's a really amazing language, but it's very, very difficult with all the characters and stuff. And then he went to China and taught math and English in some frigging rural village when he was 15 years old. God bless him. So bottom line is that it's a powerful chart. And technically, it's going to $404. So any stocks? No one wants to see anything while I'm showing this stuff to you guys?
A video.
NVIDIA? Okay. NVIDIA's chart is very strong, but NVIDIA is a cheap chip stock. So it moves like a crazy chip stock. So I'm going to clean this out, and I'm looking at the NVIDIA chart. NVIDIA, at this point, is retesting its 50-day moving average. That's 266, 265. Personally, I don't like these candles. Intraday, can you trade NVIDIA? All day long you can. All day long you can play these candles. But looking at the like more of the longer term picture, I do not like these 1, 2, 3, 4 blood red billions of dollars coming out of the company type of candles. Now, can it hold the? Can it? And I'm just going to draw some basic lines here. Oh, it's at a major critical level. It breaks the 50-day moving average. That stock can be shorted easily for $10. So this is the level that it's basically fighting right now on a daily basis. Right there. And that level happens to be 266. 266, yeah. So below 266, Milan, watch out. However, there's nothing fundamentally wrong with the company. Earnings are coming up. Maybe they're just setting up to basically get everybody out of Dodge, out of town, so they can buy the crap out of the stock. But these are not necessarily good if you just look at it from a standpoint. We need a very sharp reversal off the 266 level, which is the 50-day moving average. Now, keep in mind that these are still trending higher. Now, if we look at the shorter term charts, it's very tradable. Very tradable. You can trade the stock from 267 up to 272. These are very nice amounts of money. So if you have time intraday, I would not be like, I would try to see. I would definitely trade it intraday on the pullbacks and the pull ups, but I'd keep an eye on the daily chart to see if that 50-day moves, and I need to see some sort of green candle on the daily to convince me. Otherwise, it's a double. Look at that. It's a double top with a neckline here. There's your neckline at 260, right? So it's doing this. It's a double top, head and shoulder. 1, 2. So here's a neckline, 260. It breaks the neckline. The stock's going to go to 240 or 251, which is the 150-day moving average. So the neckline is very, very critical, Milan. That's around the 260 level. And if that neckline breaks, you can pretty much rest assured, one way or the other, the stock's going to hit 241 and 251 real fast. Could be short on that. So that's the answer to NVIDIA. Anyone else? DC, you want to see anything particular? Yvonne?
Yeah, what's going on with the financials like Goldman and JPM?
Okay, I haven't been recommending Goldman. You know that. I like JPM a lot, and I'll explain to you why. So Goldman, I don't know because I haven't charted it recently, and Goldman's not my recommendation right now. JP Morgan looks pretty damn good, very damn good. In fact, on the daily chart, if you look at that, because the characteristics of JP Morgan and Goldman Sachs are quite different. Just keep in mind, even though they're both in the sector. So I'm giving you the simplistic thing on the swing trades on JP. And JP, we have nailed some big fat profits on that. You know that. Okay, the other day we took down around 260% on those lottos. They went from 15 cents to 60 cents. That's 300% plus. You can't beat that. We've done very well on this overall. So saying that, we have a multiple stochastic bottoms here. This is looking really good. Can it reverse and die? Sure, but it's JP Morgan. It doesn't die. It just pulls back and goes higher. So bottom line is, this is very positive. So I give it a tick mark. What do we see here on the top? And I'm showing you the bigger picture here first. So on the top, what we see here, and I'm just going to, is a wide, sorry, one second. Is a very wide trading range. That trading range, this is the trading range we're moving in right now. The lower end of the range is 1012.5. And what I love about JPM, DC, is the price of the options. You can buy these things cheap because that's how they're priced, right? You don't have to pay up $2 and $3 and $4. You buy them at 60 cents. You buy them at 40 cents. You get a small candle like this, like we hit 116.86, like I'd shown. It hit exactly that. And that was just 2 days ago on the 4th. Right there with 300% plus on your money. We bought again off the megaphone lows, which was off the 114 right there, 114, 114, 114.22, 114.37. And those calls are in the pennies. I mean, not in the pennies. They're like what, 40, 50, 60 cents. So on the daily side, yes, this was the hit on Friday, but you basically place yourself here. Technically speaking, this is the level that is a major resistance, 116.86, all shown on my charts here. If it breaks 114, you want to get out of Dodge or short it if you'd like. I like the fact that the daily is just about to cross. Remember, it's been up 1, 2, 3, 4 days, regardless of the market. The SPY's been down 5 days, 3 to 4 days in a row. This is only down 1 day. 1 day. And if you bought down here, you're just kissing Jamie Dimon right there on his cheek. All right? So bottom line is that this cross is very important, very critical. And this is doing it on the daily. Forget it. Forget the 15-minute or the 1 hour. This is, to me, a powerful chart. With 117 on the top, and if it breaks that, if it's true pattern symmetry over the next month or so, then this is what is going to happen. And that is 600 to 700%. You put $6,000, you're going to take out frigging $40,000. You put $600, you're going to take out $4,000 plus dollars. That's just the way it is. So you got to scale in and out, but you don't need to day trade this baby. You need to follow the daily chart based on exactly what you're seeing in front of you right now, with a gap fill here at 114. Critical number overall. Below 114, the stock could easily drift to 113 or so. So you do not want to be long the stock below 113.80 or 114. But otherwise, it's great. Looking fantastic. Nothing's, So good question. I appreciate you brought that up. I was thinking of showing that, because this has been one of my core positions. So this is the chart. This is your wide range. We're not concerned about that right now. We're concerned about this. And as long as we don't get a break below this, and then we want to be very heavy buyers at this level. Very heavy buyers. Okay? This is a massive buy point, 113. So if for some reason we get a real slip down towards 113 and you don't get a chance to get out of your current position, whatever, then in my opinion, technically a very heavy buyer at the 113 level. But otherwise, it should hold, vacillate a little bit, and it should get up to that 117 level again, and you want to be a profit taker there and see how it reacts. It could very well come up here, 117, pull back to 116, and then make a very fast move up. Banks in general have been really frustrating. There's no question about it. I like Bank of America because the calls are cheap as dirt and they move. You can buy them at 20 cents. You can sell them at 40 cents. That's a double on your money. Now, the trick with the trading options is when you're buying that stuff, you got to buy some size. You can buy one for 20 cents and $20 and make $20 on that trade. You got to put in some money. And depending on whatever somebody wants to do, you got to buy some size on those things. I'm not saying that you should go out there. I mean, I'm not saying anything what anyone wants to do. My job is to just show you the direction stuff. How much money you guys want to put in there, that's your business. But all I'm saying is with these lottos, what happens is if you don't put in a decent sum of money, then 200% doesn't do anything for you, right? So that's just the way it is. So that's how it stands with JPM. Okay, Yvonne, do you have any quick questions?
I was thinking of JP Morgan as well. So
Good.
You answered my question.
Okay, good. JP Morgan is a great company, but great companies mean nothing. Remember one thing about trading and these type of mechanical markets. The biggest guy, which I put out on my Twitter feed last week, Druckenmiller, he manages God knows what, 20, 30 billion. Okay? Like he said, he can't even deal with these algos. So he's probably not trading technical. He's just going with fundamentals. Fundamentals mean very little over the short term. Technicals is what makes you money over the short term. You want fundamental? Fine. Buy something. Don't look at it for 6 years or a year or two. So that's the difference between tactical trading and fundamental trading. So the biggest minds in the business can trade these markets. We're still doing it. We're still doing it. So on that note, Yvonne, reminder to you, sign up as a member. We'd certainly like to have you on board. You'll learn more than you have ever learned in your life in a month to 2 months that you're going to, by the time you join and spend a month or 2 months with us. And you tell me if it makes a fundamental difference in the way you manage your money and how you do. On that note, guys, thanks a lot. What are we with futures right now? We are up about a point. That's fine. Like I said, let's make it happen. Got to keep an eye on the bigger picture. Got to keep an eye on the smaller picture to manage your trades. And that's the only way you can survive these markets. That's it. I don't make the rules.
Okay.
And God bless you all. See you guys tomorrow morning.
Thank you.
Bye-bye. Thank you.
Thank you. Bye-bye.